You missed one student loan payment and watched your credit score drop 221 points in 30 days. That's not a typo. We're talking about just one single payment. And just like that, 221 points vanished from your report forever. Ever wonder why responsible savers get worse credit than people drowning in debt? Today, I'll explain how credit scores actually work like you're 5. By the end, you'll understand exactly how one missed payment can cost you 221 points. You'll see why paying off debt sometimes lowers your score, and you'll learn what the system is really measuring instead of your financial responsibility. Here's what nobody tells you about credit scores and how they work. Credit scores aren't measuring how responsible you are with money. They're measuring how profitable you are to lenders. Those are not the same thing at all. You could have $50,000 in your savings account, pay cash for everything, never carry a balance, and have a mediocre credit score. Meanwhile, someone living paycheck to paycheck but making minimum payments on 4 maxed-out credit cards, they might have a score 100 points higher than yours. That's because we've been lied to about what the score actually measures. It's not a report card for adulting. It's a prediction tool for banks trying to figure out who's going to make them the most money. And the way they calculate that score? It's designed to keep you in debt just enough to be useful to them. Let's talk about that massive drop of 221 points. Here's exactly how it happens when you miss one payment. Payment history makes up 35% of your credit score. That's the biggest chunk. Miss one payment by 30 days and it gets reported to the credit bureaus. Boom, instant damage to your score. But here's where it gets brutal. The higher your score was to begin with, the harder you fall. Someone with a 780 score who misses one payment can drop 90 to 110 points. Someone with a 680 score, they might only drop 60 to 80 points. You're getting punished more for being better at this. It's like getting a bigger speeding ticket because you've never had one before. The system assumes you should know better, so it hits you harder. One mistake, 1 month. Everything changes forever. But wait until you hear how long it stays on your record. That late payment, it lives on your credit report for 7 years. You could pay off the entire loan tomorrow, never miss another payment for the rest of your life, and that one mistake is still sitting there like a stain you can't wash out until 2031. Meanwhile, if you pay off a credit card and close the account because you're trying to be responsible, your score can drop 20 points just for doing the smart thing. You get punished for mistakes for 7 years. You get punished for responsibility immediately. Now here's the part that makes people's heads explode. The credit system rewards you for staying in debt, not drowning in it, just enough to keep you paying interest every month. It's called credit utilization, and it's 30% of your score. They want to see you using credit, but not too much. The magic number? About 30% of your available limit. So if you have a credit card with a $10,000 limit, they want to see you carrying a balance around $3,000. Not paying it off completely, not maxing it out. Just existing in this sweet spot of debt that's perfect for them. Pay off your balance completely every month like a responsible human, your utilization drops to 0. To the algorithm, you look like you're not using credit. And if you're not using it, they can't predict how you'll behave when you're in debt. So your score doesn't climb as fast as someone who's carrying a balance and paying interest every month. You're literally being punished for not making banks money. Here's another twist that trips people up. Credit age matters more than you think. It's 15% of your score, and it's calculated by averaging how long all your accounts have been open. That credit card you opened in college 10 years ago, it's boosting your average account age right now. Close it, and suddenly your average drops. Your score can go down even though you didn't do anything wrong. This is why financial advisors tell you to keep old cards open even if you're not using them. Stick them in a drawer, set up one small automatic payment like Netflix, and let them age like fine wine. And student loans? They're particularly brutal because of how the system categorizes them. Credit scores look at different types of debt differently. There's revolving credit, like credit cards, where the balance goes up and down. And there's installment credit, like student loans, car loans, mortgages, where you borrow a chunk and pay it back in fixed amounts. The system wants to see you managing both types. But here's the kicker. Student loans often make up the oldest account on your credit report, especially if you took them out at 18. So when you finally pay off your student loans, something that should feel like financial freedom, your average account age can drop. Your score can actually go down when you finish paying off your debt. It's like being penalized for graduating from debt. You spent years making payments, doing everything right, and your reward is a lower credit score because now your oldest account is gone. Here's something else that doesn't make sense. Credit inquiries. Every time you apply for new credit, the lender does a hard pull on your credit report. Each hard inquiry can drop your score by 5 to 10 points. They stay on your report for 2 years. Now, if you're shopping around for the best mortgage rate, you might apply to 3 or 4 lenders in the same month. The system knows this is responsible behavior, so they usually count multiple mortgage or auto loan inquiries within a 30-day window as just one inquiry. But credit cards? Each application is a separate hit to your score. So if you're trying to open a few cards to optimize your rewards, the system punishes you for it. You're being strategic, but the algorithm sees you as desperate for credit. This matters because nobody's teaching this in school. Nobody's sitting you down at 18 and saying, the financial system is not designed to help you get out of debt. It's designed to keep you in it at a manageable level for as long as possible. Instead, we get advice like, pay your bills on time and don't max out your cards. Which is fine, but it's leaving out the most important part. The game is rigged against you from the start. Not in some conspiracy theory way, but in a very legal, very profitable way. The credit scoring models were built by the financial industry to predict lending risk, and the best customers for them aren't the people who never borrow. They're the people who borrow constantly and pay just enough interest to stay afloat without defaulting. So what do you actually do with this information? You play the game, but you understand the rules. Keep your credit utilization between 10 and 30% if you can. Set up autopay on everything so you never miss a payment, even by accident. Don't close old credit cards unless they have annual fees you can't justify. And if you do miss a payment, call the lender immediately. If it's your first time and you've been a good customer, a lot of them will remove the late payment report as a courtesy. They won't advertise that, but it's worth asking. One phone call could save you a massive drop and 7 years of damage. But here's what really needs to change. We've normalized a system where financial institutions have more power over your ability to rent an apartment, get a job, or buy a car than your actual bank account does. Your credit score can be excellent while you're drowning. It can be terrible while you're thriving financially. And a single mistake, one you made when you were 19, one you made because you were in the hospital and forgot, one you made because the payment portal was down, can follow you for nearly a decade. That's not accountability. That's punishment dressed up as data. To recap everything we just covered, missing one student loan payment can drop your score by over 200 points because payment history is the biggest factor, and the system punishes higher scores more severely. That late payment stays on your report for 7 years. Credit scores reward you for staying in debt at 30% utilization, not paying everything off. Paying off loans can actually lower your score by reducing your average account age. The whole system isn't measuring responsibility, it's measuring profitability for lenders. And nobody's teaching you this until it's too late. So here's the real question we should all be asking. If your credit score doesn't reflect how good you are with money, if it punishes you for getting out of debt and rewards you for staying in it, should we even be using it to decide who gets housing and jobs? Or is it time we built a system that actually measures financial responsibility instead of how much profit you can generate for banks?